Ever get that feeling, like companies, maybe they're not being totally upfront about their finances. Like they're trying to make those books look a little too good.
Hmm.
Yeah,
I know what you mean.
that's where this thing, IFRS 16, it comes in. It's like
Yeah.
almost like financial detective work, right? Bringing those hidden obligations out into the light.
Yeah.
And you know what? It's not just for the accounting whizzes. It affects way more than that.
It really does. It really
This
does.
is impactful for pretty much everyone.
Absolutely. Yeah. And IFRS 16, it really tackles this area that was, I think, previously kind of overlooked a lot, and that's leases.
Rama.
Before the standard came along, companies could essentially keep a lot of their lease obligations, kind of under wraps, hidden, making their financial picture look a bit rosier maybe than it actually was.
So it's like, okay, imagine this. You're, I don't know, renting a fancy sports car trying to impress a date,
Okay.
but you're conveniently forgetting to mention that you're still paying off that, like, beat up old truck in the driveway.
That's a great analogy. That's exactly it. And that hidden truck payment, that can make a huge difference for investors or anyone trying to really look at the company and assess, like, are they really financially healthy? What's going on here?
Yeah, it's a big deal.
Big time. IFRS 16 levels the playing field, brings those lease obligations front and center on the balance sheet where they should be.
Now we're talking real world impact here.
Real world, absolutely.
But before we get ahead of ourselves, let's break this down a little bit, okay?
Okay.
What exactly changed with IFRS 16? Like, what did it actually force companies to do differently?
It boils down to this. IFRS 16 requires companies to recognize almost all leases on their balance sheets.
Okay, I'm already a little lost.
Okay, so think of it this way.
Right.
Before IFRS 16, if you were leasing something, it was almost like paying rent, right?
Okay,
You saw the expense each month. It came out of your account,
sure.
but it didn't actually show up as debt that you owed.
Interesting.
IFRS 16 comes along and changes that. So now when a company leases something, they have to record two things, a liability and an asset.
Okay, whoa. Hold on. Two big accounting terms right off the bat. Let's break those down for our listeners who maybe they're not, financial analysts.
Sure.
Let's start with liability.
Okay.
What does that even mean in this context?
So the liability, often called a lease liability, basically represents the company's obligation to make all those future lease payments, right? It's
Yeah.
like taking out a loan, you're getting something now, but you're going to owe money later on down the line.
Okay, that makes sense.
Yeah.
And what about that asset you mentioned? What's the deal with that?
That's called a right of use asset. Now, this one represents the company's right to use the leased item for, however long that lease lasts. So it's not like they own the asset outright, but they do have this right to use it, and that's valuable.
Okay, so to bring this to life a little bit, all right.
Okay.
Let's imagine a company, let's just call them, I don't know, Groovy Company.
Groovy company. I like it.
Groovy Company leases let's say, a high-tech 3D printer. They're going to make custom phone cases.
Oh.
They need this to run their business.
All right.
So they sign a lease agreement. IFRS 16 enters the picture. What happens?
Okay, so Groovy company, they need this 3D printer. It's crucial for their business. They sign that lease agreement.
Right.
Let's just say, for the sake of this example, the present value of all their future lease payments for this printer is $188,000.
Okay.
So under IFRS 16, that $188,000, that becomes their lease liability.
Okay.
They are acknowledging that debt, essentially, for the right to use that printer.
Okay, so that's the we owe money part.
That's the we owe money part.
But they aren't getting something in return, right? That's where this right of use asset comes in.
You got it. Groovy company, they would record a right of use asset, and it would also be for that $188,000. So that signifies, hey, we have the right to use this really cool 3D printer to make all those phone cases, even though technically we don't own it.
Okay, got it. So they owe money, but they also have this valuable asset they can use.
Exactly.
But why does all this matter? Like, why is it such a big deal to put it on the balance sheet like this?
Because it changes how everyone, investors, creditors, anyone who's analyzing Groovy company, how they view their financial health. Suddenly on paper, they look a little more asset heavy and a bit more debt heavy. And that can influence things like their credit rating or their ability to get loans in the future.
It's like before IFRS 16, companies could kind of, I don't know, downplay how much they were relying on all these leased assets.
Yeah, they could fly under the radar a bit.
Exactly.
IFRS 16 pulls the curtain back.
It's like, aha, look what you're really working with here.
Exactly.
Let's be real.
It brings that transparency.
Yes, transparent.
And this is just the start.
Oh, no.
Just wait till we get into the nitty-gritty, the terms, the calculations. That's where it gets really interesting.
Oh, boy. All right. Well, listeners, buckle up because we're
Okay.
about to dive even deeper after the break. Okay. So we've established IFRS 16. It's all about bringing those lease obligations out into the open.
It is.
But before we get lost in the weeds here with
Sure.
all the numbers,
Yeah.
let's just, clarify a couple of these key terms.
Sure.
For example, we keep saying this phrase, right of use asset. What does that actually mean?
Right.
And what makes it an asset in the first place?
So think about a right-of-use asset this way. Imagine you're opening up a really cool new cafe, and you're leasing, let's say, a vintage jukebox.
Okay.
You want to bring in those cool vibes. You need that music. Now, you don't own that jukebox, right?
Right.
But your lease, that gives you the right to use it to fill your cafe with awesome tunes, attract all the customers.
Yeah.
That right to use the jukebox for however long your lease lasts, that's the right of use asset.
So it's like, okay, so I don't own the actual jukebox,
Right.
but I have the keys to the jukebox kingdom, essentially,
Yeah.
for a set amount of time.
Yeah, exactly. And that, right, it's valuable, right? It's letting you generate revenue, it's attracting customers, it's helping you run your business.
Right.
But here's where IFRS 16, it gets even more interesting, okay?
Okay.
It's not enough to just have the right to use something. You also need control.
Control. So, like, with our jukebox example, does that mean I get to choose what songs play?
You got it, you're on the right track.
Okay.
Control, in this context, in the IFRS 16 world, it means you have the power to decide how that asset is used,
Okay.
and you benefit from those decisions. So going back to that jukebox, if you're the one picking the tunes, adjusting the volume, maybe even deciding when it's on or off,
Right.
that signifies control.
Right.
You're calling the shots.
You're the DJ.
You're the DJ, exactly.
So it's not just passively using it.
Right.
It's about I have the freedom.
Okay.
I'm making the decisions
Yes.
that benefit my business.
And IFRS 16, they're looking for two main things to determine, like, does a lease even exist?
Okay.
And is this control really there? First, do you have the right to get most of the economic benefits from using the asset?
Okay.
Like, in our example, are you the one pulling in those cafe customers?
Yeah, are they coming for the vibes and the music?
Exactly. And potentially, are you making more money because of that awesome jukebox?
Right. Right.
The second thing, do you have the right to direct how that asset's used, like we talked about, with choosing the music?
Right, being the DJ.
Being the DJ.
Okay. I think I'm starting to see how this all fits together.
You're getting it.
But before we move on, quick knowledge check here.
Okay.
Remember Bolt Company from earlier? They leased some equipment. Let's see if our listeners are paying attention.
I like it, pop quiz.
All right, pop quiz time. Bolt Company, they snagged a 5-year lease on some equipment.
Okay.
Think, I don't know, top-of-the-line espresso machine, right?
Yeah, crucial.
Crucial for their business.
Absolutely.
The total cost, after all those present value calculations, $120,000 in lease payments.
Okay.
But they also had $5,000 in initial direct costs. Things like installation, delivery, got to get that espresso machine in there.
Right.
And because Bolt Company likes to be smart, they made a $10,000 upfront payment.
Okay.
No residual value guarantees, no tricky variable lease payments, no purchase options, none of that.
Straightforward.
The lessor, they keep ownership at the end of the lease. Pretty standard stuff.
Okay.
So based on everything we've talked about, all this IFRS 16 stuff,
Yes.
what should Bolt Company be recording on their balance sheet?
Well, they'd start with a lease liability of $120,000.
It's okay.
That represents their commitment, right?
Yeah.
Those future lease payments.
Right.
But their right of use asset, that's a bit higher, it's going to be $135,000
Oh, okay.
because we add those initial direct costs, the $5,000,
Right.
and that upfront payment of $10,000 to the present value of the lease payment.
So even though they paid that $10,000 upfront, it's still like spread out, right?
Exactly.
Over the whole lease.
It's like a down payment on a house. You're making a big payment up front, but you still owe the rest.
Okay.
It's all about recognizing that true cost. What does it really cost to have the right to use that asset? For Bolt Company, it's that amazing espresso machine.
Okay, that makes sense. But lease payments themselves, those seem pretty straightforward.
You'd think so, wouldn't you?
You just pay the same amount every month,
Right.
like clockwork.
But IFRS 16, ever the stickler for details,
Of course.
cares about when those payments are made.
Really?
Because it affects how that lease liability actually changes over time.
Wait, so there's more to it than just, here's your fixed monthly payment.
There's always more, right?
Done deal.
This is where it gets interesting.
Okay.
Imagine you're at a coffee shop
Okay.
Maybe one using Bolt Company's leased espresso machine.
Nice.
You order your latte, you enjoy it.
It's delicious.
The best, right? And then you pay on your way out.
Okay.
That's like paying in arrears. You're settling up after you've already benefited.
Okay, so what's the alternative? Am I like prepaying for my latte?
Essentially, yeah, that's paying in advance.
Okay.
You're paying for the right to use something before you even use it.
So like my gym membership.
Exactly. Or a subscription box. You pay up front for the month's worth of goodies.
Right.
Now, why does any of this matter for IFRS 16?
Yeah. Why?
Because the timing of those payments. That affects how much interest gets added to your lease liability over time.
Interest. So it's not just about the fixed lease payments. There are these like behind-the-scenes interest calculations happening too.
Oh, absolutely. Let's go back to Groovy Company and their 3D printer.
Okay.
Their present value of lease payments, $188,000, remember?
Right.
And they've got an implicit interest rate of 10.54%.
Okay.
Now, if they're making those annual $60,000 payments in arrears, at the end of each year,
Okay.
their lease liability, it actually goes up a little bit before it goes down.
Wait, really? Even though they're making payments, the liability still increases.
Because of that interest.
Wow, sneaky interest.
Right. In that first year, they're hit with an interest expense of 10.54% on that initial $188,000. Okay. That adds up to $19,815, so their liability goes up before they even make their payment.
Wow, interest can really sneak up on you.
It really can.
Wow.
Then, of course, they make their $60,000 payment, brings the liability down. They repeat this every year.
Right.
The interest expense, it's calculated on whatever that remaining balance is.
Right, so it's like slowly chipping away at a loan, but with this added interest thing.
Exactly. Now,
Right.
if they were paying in advance, that would change things up.
How so?
If Groovy Company handed over that first $60,000 right away, boom, up front,
Okay.
their lease liability wouldn't decrease immediately.
Oh, interesting.
They would just have the interest expense for that year.
Right.
It's only in the second year that their upfront payment is fully reflected.
Wow, the timing really does make a difference.
It does, and it highlights how IFRS 16, it moved away from just looking at lease expenses, and it's now reflecting the real financial picture of these agreements.
It's like a long-term view.
Exactly.
Yeah.
Holistic view, if you will.
I like it. I like it. But let's be honest, this seems pretty intense for every single lease a company has.
Right.
What if they're just, I don't know, leasing a couple laptops?
Laptops, some office chairs.
Yeah, like we're not talking big machinery here.
You've hit a very important point.
Okay,
IFRS 16 gets it. Accounting for every stapler would be a bit much.
that's a good point.
That's why they built in some exemptions.
Okay, good.
For those short-term leases and those low-value leases.
Short-term, low value. Okay, I like it.
Yeah.
So what counts as short-term or low value in this world?
Short-term is simple. Any lease, 12 months or less. Don't overthink it.
Straightforward.
Low value, it's a tad trickier.
Okay.
Think of things that are readily available.
Yeah.
You can find them everywhere.
Uh-huh.
And they wouldn't really impact a company's financials in a big way.
So like those laptops, those office chairs I was talking about?
Exactly. Cell phones, office supplies, that's the stuff we're talking about.
Okay.
IFRS 16 even gives you a little threshold, less than $5,000 when new.
Okay, so it keeps it practical.
Practicality.
I like it. I like it.
It's all about balance.
So for these exempt leases, companies can use simpler accounting methods.
Exactly. They just recognize those lease payments as an expense.
Okay.
On their income statement, no need to go through the whole IFRS 16 calculation marathon.
It's all about finding that balance, right?
Right.
We want useful information, but we don't want to get bogged down in the tiny details.
Exactly. We want the big picture.
So as we wrap up our IFRS 16 deep dive here,
Yes.
what's the one thing our listeners should remember? What's that key takeaway?
IFRS 16, it brought lease accounting into the spotlight.
Out of the shadows.
No more hiding.
Mm,
It's not just a line item on the income statement anymore.
right.
It's got a real impact on the balance sheet.
It's a big deal.
It changes how investors see things.
No more hiding those obligations.
Transparency.
Transparency. And while it might seem a bit complicated at first,
It's got its nuances.
understanding the basics can be really empowering.
Absolutely. Knowledge is power.
Couldn't have said it better myself. Now, here's something to think about for all you listeners out there. How might understanding IFRS 16 change your own approach, right?
Interesting.
When you're leasing or renting something, or even your investment decisions. Food for thought.